Disclaimer. The information has been prepared by the Financial Freedom Compass YouTube channel for general information purposes only. We do not guarantee the accuracy of the information presented and its suitability for investment decisions. The investment information, comments, and/or recommendations provided on this channel do not constitute investment advice, as we are not a financial advisor. You can watch the full version of disclaimer on the link in the description section. Did you know that last year the world's highest earning hedge fund made a profit of approximately $13 billion USD? And did you know that last year the top 10 highest earning hedge funds in the world made a profit of approximately $57 billion USD? So why do these funds make such high profits while you, as an individual investor, are constantly making losses or not making enough profit to beat inflation or stock market indices? What are the tricks that these funds do differently than you? In the next 10 minutes, you will learn how to make money in the stock market like the legendary investors who manage billions of dollars. Let's get started. Basic principles. The basic principles of making money in the stock market. First, having the right information. Second, think strategically. Third, to act in a disciplined manner. Let's dive in. First, knowledge and education. The first step to success in the stock market is to have financial literacy and market knowledge. Everyone thinks that they can be successful by learning fundamental and technical analysis. But the most important secret of hedge funds is to understand and read the market dynamics and take positions before the others. Without understanding market dynamics, fundamental and technical analysis will not make any sense.
Everything happens for a reason and is often revealed in perfect timing. Anonymous.
Second, research and analysis. You don't buy a stock because of FOMO or because social media influencers say. So without knowing what you are buying, you have to analyze the company's financials, industry trends, and macroeconomic data. Hedge funds spend millions of dollars just for these jobs and hire their kids who have graduated from the best schools in the world just for these jobs.
If you don't understand a company, if you can't explain it to a 10-year-old children in 2 minutes or less, don't own it. Peter Lynch.
Third, risk management. Every transaction you make without learning the risk-return balance or diversifying your investments can have negative consequences that can cause very serious losses. Hedge funds never make an investment that they can't calculate or that goes beyond the rules written in their manifestos.
The essence of investment management is the management of risks, not the management of returns. Benjamin Graham.
Fourth, psychological resilience. Psychological resilience goes hand in hand with the quality of your investment. A risk that is too big for you to bear and the loss that may occur with it will wear you down psychologically and cause you to make hasty and wrong decisions. Hedge funds have predetermined red lines and investment rules that they will never violate. This allows them to be patient and cool-headed in the face of market fluctuations and to act based on rational analysis rather than emotional decisions, which leads to long-term success.
It's not whether you're right or wrong that's important, but how much money you make when you're right, and how much you lose when you're wrong. George Soros.
Strategies. There are a wide variety of strategies that can be followed to make money in the stock market. As an individual investor, choosing options that require patience and time with low risk and high return is the key to certain success. The strategies shared below are given as examples of strategies applied by professional hedge funds for information purposes only. Buy and hold strategy. Investing for the long term and waiting for stocks to appreciate in value. This strategy requires patience to avoid being affected by market fluctuations. Active investing. Profiting from market movements by short-term trading. This strategy requires market monitoring and the ability to make quick decisions. Value investing. Buying shares of companies with low market capitalization but high potential. This strategy requires knowledge of fundamental analysis and company valuation. Growth investing. Investing in the shares of companies with the potential for rapid growth. This strategy requires forecasting future growth trends. Dividend investing. Investing in the shares of companies that pay regular dividends, generating both capital gains and regular income. How hedge funds work. It is not possible to develop 100% identical strategies or invest in the same instruments as hedge funds, either in terms of accessibility or capital size. While hedge funds can make different investment decisions by monitoring global macro trends, event-driven funds try to evaluate opportunities on an event basis by following mergers or bankruptcies. They also seek to take advantage of arbitrage opportunities by identifying misvaluations in market prices, such as relative value. Of course, most importantly, in accordance with the directional model, they aim to turn them into profit by following strong and long-term trends in the market with the motto, "Trend is your friend." Conclusion: what needs to be done as an individual investor is to synthesize the methods applied by professionals into simple models that can be applied and sustained for a long time. You will find videos on how to do this and how to implement them on this channel. If you liked the video, please subscribe and hit the notification button so you don't miss any future videos. Until see you in the next video, chase the smart money and take care.